index annuities is an insurance product that is tied or linked to a stock index. Typically the S&P 500 or maybe the Dow Jones Industrial Average. And they're typically sold to older investors or to unsophisticated investors. Now, these can be attractive in certain limited situations for a small number of investors, but generally, Rudy and I suggest that you shy away from these. And there's several reasons why. First of all, there's high commissions that are paid out. Generally 10 to 20%. Guess what? You're paying for that. Number two, that high commission creates a potential conflict of interest where while you're being put in these, where there may actually be more attractive investment options with a much lower commission. Number two, if you want to get out of them, forget about it. They often have very high surrender fees. I'm talking 10%. I'm talking 20%. And they don't end in 1 year. They don't end in 2 years. We've seen them sometimes stretching out to as long as 15 years. That's simply just too much. Also, if you look at the complicated formulas to see exactly what you get, you're going to find out that in the vast majority of cases, you're going to do worse than the stock market. You don't participate in all the gains. You may not receive dividends. You need to look at that and read that fine print and make sure you understand it. Now, these are objections that are fairly common that are brought out in the literature. In order to go ahead and convince you to invest in these, many of these insurance companies offer what are called guaranteed minimum returns. They could be very attractive, perhaps 6%, perhaps 7%. However, there's a huge catch, and that huge catch is this. You're going to be required to annuitize these. When you annuitize them, over the entire life of the investment, guess what? That 6%, that 7% can go as low as 3% or 4%. You're probably better off going with corporate bonds or perhaps even CDs. They also typically invest in only one asset class, that's stocks, and also you're only typically going to make money in one direction. You want to take a look at other strategies, other investment vehicles that are much cheaper, much more flexible, and give you more opportunities to go ahead and make money. Now again, equity index annuities in certain situations for certain investors may be a viable option, but generally speaking, they're better for the agents, they're better for the financial advisors selling them.